Hey, if you're looking to implement a roll-up acquisition strategy and you need a financial model to help you model how the consolidated units that you're going to be acquiring will kind of play together, what the cash flows are going to look like, and ultimately what the potential return could be for this roll-up strategy, then you've come to the right place, because we have built a financial projection template built specifically for this type of use case. I'm going to walk you through how to fill this template out. I put a link in the description of the video below that's going to send you to our multi-unit business template. And it is a generic template out of the box, but in this video, I'll walk you through how I would fill it out if I were implementing a roll-up acquisition strategy. So before I get too far into that, my name's Adam Hooksum. I'm the co-founder of Projection Hub, and over the last decade, we've helped over 50,000 entrepreneurs create financial projections for potential investors and lenders. And today, again, we're going to be focused on a roll-up acquisition strategy financial model. So with that, let's go ahead and dive in. All right, so for the sake of having some sort of example here of what we're going to be acquiring, I'm going to pretend that we are acquiring a number of small town veterinary clinics. And maybe this is just one veterinarian in a small town, and we are going to acquire these individual business units and kind of integrate them into our platform company and try to grow a large network of vet clinics in small towns. And so what we're seeing here is kind of the end process, the end deliverable, a consolidated at a glance of all the units that we're going to be acquiring, a 5-year projection. You get some per business unit data summary here as well, some different graphs and charts. Then you're also going to get a 5-year cash flow summary, a 5-year income statement summary, a 5-year balance sheet summary, and these are all consolidated, and then a 5-year income statement broken down by month, and then same thing with the cash flow broken down by month and balance sheet broken down by month. So you'll get that monthly detail as well as annual summaries. That is the deliverable. We'll have a little bit of work in order to get there, so I'm going to jump back over here and walk you through how I'd fill this out. So let's say this is Adam's vet roll-up. We're going to roll up these vet clinics, and we're going to raise some investment here. So in month 1, we're saying we're going to raise $1 million. In month 13, $2 million, month 25, $5 million to help implement the strategy. We can implement accounts receivable and accounts payable terms for those individual units, as well as inventory. Let's say maybe we do have $10,000 worth of inventory, and we're going to have the clinic keep 10% of their monthly sales on hand as inventory. All right, so then what we can do here is we can add in fixed assets other than the individual business units that you'll be rolling up. So this would be the corporate office type fixed assets. So we could have some leasehold improvements for a corporate office, maybe that we're renting, and maybe we have some furniture. So added those in. Now we're getting here to the business unit. So we're going to say, hey, we're starting with, maybe we're starting this roll-up strategy just as an individual, not backed by major private equity, but just an individual that's trying to roll up these small units. And so you're starting out by just leasing a lease-to-own option with the first vet clinic. And so maybe you don't have the cash to purchase it, or you're not going to take out a loan to purchase the unit, and you're just going to do a lease-to-own option. So from this drop-down box, we've selected lease. And that's going to be in month 1 of the model. We're going to pay the vet owner $10,000 a month for the lease for 120 months, as an example here. And so then for our second unit, though, we're going to acquire another unit, and we're going to purchase this unit. And so for this unit, we're going to pay $350,000 to purchase the unit, or to acquire that vet clinic. And we're going to amortize that over 30 years. We're going to make that purchase in month 3. And then here we can set up our financing. So if you're getting a loan to make that acquisition, here we've assumed it's the purchase price times 0.75%, so 75% financing with debt in this example, 7% interest rate over 10 years. So again, that was just rolling up one unit. Say we add another unit in month 9. And then month 13, we raise that big chunk of money up here. We raised $2 million. And so now we are going to go out and acquire 7 additional units. So whether that's 7 individual units or all that we acquire all at once in the same month, or it could be that you kind of take out another small network of vet clinics here in this example. So, and then this will say, this is the purchase price per unit. So $500,000 per unit, per business unit, per vet clinic. And then again, the financing per unit. then lastly here, we're saying we're going to purchase or acquire units 11 through 20 in month 25, so the beginning of year 3. And these units are going to cost us $550,000 per unit. And again, we're going to finance 75% of that with debt. All right, so now we can jump over to our import revenue tab, where it's going to pipe this information in. And we have each row represents, we're saying it represents one business, but multiple units in that business. And so we've got the purchase start month that's been piped in from the other tab. But here we're saying the first month of revenue that we're going to get to generate from these units has a 1 month delay. So if we acquire the business in month 1, we're just what I did is I just added a 1 month delay for the first month of revenue to kick in. And then these are the number of units as we talked about. And then here's the average monthly revenue per business unit. So we're saying the first unit we took on to $20,000 a month in revenue. And then that probably doesn't make a whole lot of sense because we were paying $10,000 monthly lease. So I'm going to change that. Say this is a very small vet clinic and we're going to lease to own it for $3,000 a month. Probably makes a lot more sense. Okay, so coming back to that, you can put in your average monthly revenue per business unit at $20,000, $22,000 for the next one, $24,000 for the next one that we bought. And you can see we're kind of going up the food chain as we're acquiring larger revenue businesses. But then this column will multiply the number of units times the average monthly revenue. And then we'll need to put in the cost of goods sold for each business unit. So again, this is per business unit. And what I've done is for material cost, said this is a percentage. So 0.25% of revenue is on our material cost. And then for labor, put in 0.22 for labor cost, so 22% labor cost. Then you have slots to put in other cost of goods sold, property tax if you have it, other direct costs that you might have. So that will give us our total direct cost per month per unit. And then what I've done down here is you have the ability to provide an annual increase in revenue for these units. And so that's going to increase this number, this average monthly revenue. And let's say we're going to implement this roll-up strategy. We are going to implement best practices at a lot of these different small town vet clinics, and we think we can increase our annual revenue by 15% a year. And increase in expenses, we're not going to see much of an increase in expenses, just maybe a 3% inflation rate. And so then that will allow us to project our revenue and expense for those units. And it will all consolidate down here. And then what we'll do is jump over to our input other expense tab. And this is where you can enter in corporate expenses. So you could have your corporate level expenses. You could also have additional expenses that you want to kind of detail out on a per unit basis as well. So I'll show you some different options here. You can pick from this drop down whether an expense is a fixed dollar amount, a per business, or a per unit. And so in this case, you could potentially have a situation where you're buying holding companies, businesses, and then each business holds multiple units. That's not really the use case in our example. So the per business cost is kind of irrelevant. So we're going to look at the per unit cost. This is the per unit, per vet clinic cost. And so we're saying, hey, we're going to spend, let's keep this as fixed. We're going to spend on general marketing. We're going to spend $1,000 a month for just general marketing of our network of vet clinics. But then on a per unit, per vet clinic level, we're going to spend $150 a month for some local marketing. Might also have different fees, different expenses on a per unit basis. You could put in here, office rent, for example. This could be the corporate office rent. If you keep it at fixed, it's probably going to be, just the rent for that one particular office. But if you want to put in rent on a per unit basis, you can do that as well. Now, finally, I'm going to hit on credit card processing as an example of our percentage of revenue expense. So credit card, if, let's say 50% of your sales, of your business unit sales are generated with a credit card, and the credit card charges 3% roughly of the sale as a fee. And we're saying, hey, 50% of our total sales are with a credit card. So 1.5% of our total revenue, so half of that 3% fee, 1.5% of our total revenue will be credit card processing fee. Right, and then finally, we can input salary position. So you wouldn't want to enter in salaried or labor for the individual business units on this tab. This should be the corporate level staffing, so the CEO, CFO, that sort of thing. And we have the ability to add salaries, benefits. Oops, we don't want, that did not drag down properly. We don't want 107% employer taxes. You have the ability to have a start month. So we're saying, hey, we're going to start the CEO right on month 1. Maybe that's you. And then the CFO is going to start in month 13 as we acquire more units. And then we'll have our COO, Director of Marketing, Controller will all hire when we make that next jump up and raise that next round of funding in month 25. You have the ability to add in an annual raise for those employees as well. And all of that will bring us back to our at a glance tab. You can see the consolidated view of the start of our vet clinic empire and what those key ratios are going to look like on a per unit basis as well as consolidated. So hopefully this has been helpful and kind of give you some ideas of how you can use this template in your roll-up acquisition strategy. If you have any questions, please don't hesitate to reach out. You can leave a comment in the comment section of the video below if you have a question that you think would be useful for everybody. That would be great, and we can answer it there. Otherwise, feel free to reach out directly to us at support@projectionhub.com, and we'll do our best to help you there. Thanks.